If you go to investment banks, it is covered by the FICC division, fixed income, commodities and currency trading. I am happy as my money amount. Exactly. Zero amount, zero happiness. $1 million happiness. Oh, $1 billion. Well, 1,000 times happier. Exactly. That's risk neutral person. Hello, how are you? Welcome back to International Finance, Chapter 7, Week 9 portion of my lecture. And how did you like midterm reports, right? I hope you liked it. If you believe that you are screwed, then you are not alone, okay? Everybody got screwed, so everybody's doing okay, hopefully, okay? But let's see. I didn't grade it yet, so I'll come up with a better answer next time. But anyway, current issue, North Korea. I told you so, okay? North Korean state media reports Kim Jong-un made first public appearance in weeks, right? This is yesterday's news, right? After 2 weeks of, or 3 weeks of not showing up in the media, okay? People were speculating a lot about, wow, is Kim Jong-un dead or not? Come on, okay? If Kim Jong-un were a narcissist, right, this would be a best situation for him because everybody think about it, okay? Think about it. You and me or anybody in the whole world, who would care about your existence in the media over the next, 1 week or 2 weeks? So much so that if you're absent, they will say, where is he? Where's Andy Kim? Is he dead or not? Nobody pays attention to me. But Kim Jong-un, right? People start to speculate and then give some media attention like that. Putin, he does not have this kind of media attention either. Maybe Donald Trump, okay, and then maybe Donald Trump, but not to this degree, I guess. So maybe Donald Trump, as a narcissist, may envy Kim Jong-un so much, right? We don't know. Anyway, remember when it comes to North Korea information, okay, British media is the one that you have to pay attention. But this time I showed you on the day of the news release about the rumors, right? It was US media, CNN, and then South Korean media that was just like hyping of this. But British media were rather silent, which means nothing is going on, right? Don't believe CNN or US media is the best in terms of North Korea information. Okay? It is British. It is not Chinese. Chinese media, they are state controlled. Do you think they will be able to release anything that is not allowed by the government? No way. How many people died of Corona-19 virus? We don't know. How about Japan? It's the same, okay? And then, moreover, Japan, right? They don't exchange ambassadors with North Korea. Less of an information. South Korea, we have some intelligence sources, but they are not effective, right? MI6 or 007 may be better than CIA for this, right? And Korean media and intelligence should pay more attention to London or the places where North Korean ambassadors are stationed. So, The Economist, right? London, this kind of places and this kind of media, that's what you should pay attention to. When it comes to international politics and geopolitical risk itself, right? Read The Economist, okay? And Korean intelligence services should send their people to Pyongyang directly, which is mission impossible. Dun 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 dun. Ba-da-bum, 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 ba-dum. Yes. The ruling parties in South Korea and the US were not moving, but the opposition parties were hyping a lot more about the death speculation. Why is that the case? Because, well, they may want some more uncertainty coming up so that the ruling party will have a hard time. Maybe. Okay? 몽땅, 망해라. Yeah, kind of things. Maybe. It doesn't mean that I wish Kim Jong-un prosper or whatever. I don't like him at all. But, we have to be realistic. Okay, that's what I'm saying. And chapter outline for chapter 7. Let's go. Yeah, this is perhaps the most difficult part from teacher's perspective. Okay, to teach you guys, because it involves option pricing. How many of you have taken the derivatives class? Options, derivatives, and futures market kind of things, right? Not many of you, I believe. Maybe some of you, okay, because this is more like a third year and fourth year students class, right? But this one assumes that you have some solid understanding about this subject, right? So here I will give you some kind of refresher, okay? Assuming that you did not take those classes, okay? So let's go through one by one. Futures contract preliminaries, we're going to talk about it. And then currency futures markets will be discussed. And then basic currency futures relationships. And then options contract preliminaries will be given to you. And then currency option market and currency futures options market. What? Currency market and currency futures options market. Equivalent thing, right? But you're going to talk about these things and basic option pricing relationships and expiries and American option, European option, binomial option, European option pricing model, Black-Scholes models, all kinds of things will be discussed. And then, so first thing first, this is futures, right? Futures is a contract. Okay, this is like a forward contract. In Korean terminology, futures is a 선물 거래. Okay, 선물 does not mean present, but 선물, something advanced, futures. And then forward market is 선도 거래 kind of things. Futures is like forward. Okay, futures is like forward, but it's just more standardized so that everybody in general public can trade anonymously. Forward contract is much more tailor-made, so that these contracts, forward contracts, are made between you and me or any private individuals or entities, right? Companies can do it. Is as a private transaction. Anyway, a futures contract is like a forward contract in that it specifies that a certain currency will be exchanged for another at a specified time in the future at prices specified today. A futures contract is different from a forward contract in that futures are standardized contracts trading on organized exchanges with daily resettlement through a clearing house. Okay, now standardized features. What do you mean standardizing? Well, the contract size, right? Contract size. Well, forward contract, you can make a contract like whatever amount that you want to, transact, right? 997 million and then 53,000 US dollars kind of things, right? Whatever amount, you can do it in forward contract. But in futures market, it has to be traded among somebody you don't know, between you and somebody you don't know. Okay, forward contract on the other hand is like the guy, you directly call up the guy who is going to transact with you. Okay, so that you can tailor make it. But futures is like you have to be able to buy and sell it in the public marketplace called exchanges, right? Exchanges. Now, so that to facilitate this kind of transactions, the contract size has to be standardized. Okay, for example, 100,000 euros unit, right? Every contract has to have that kind of contract size. It depends on the regulation of each exchanges. And delivery month, right? Forward contract, you can specify whatever promise that you make, right? going into the future, like 10 years down the road, right? Or 5 years down the road, make a forward contract. But in futures, okay, to facilitate the speed of the trading, okay, the delivery month has to be standardized, and daily resettlement scheme has to be there. Forward contract, well, you don't have this kind of daily settlement. The thing is, forward contract is a private transaction, so that 5 years down the road, you make a promise that you're going to buy US dollars at 1200 Korean won. But what if the US dollar value in Korean terms goes down to 800 Korean wons, and you still have to pay 1200 won per dollars? Okay, can you afford that? Well, in forward contract, there is no daily resettlement, but you just keep silent and then just move on until the maturity, and then get screwed at the final stage. But in futures market, they want to have a stable market system so that nobody gets screwed up totally at the final moment. So daily resettlement based on mark-to-market system has to be there. Okay, every day the exchange asks you, the investors, can you afford this? Can you afford this? Can you afford this? Margin calls will be there. Okay, so that you have to verify that you can afford it, and then set up the amount. An initial performance bond, okay, margins, right, will be there for you, and which is about 2% of contract value, and then is cash or T-bills or held in a street name at your brokerage. So you have to put in some collateral kind of things as a margin or initial performance bond to verify that you can afford this kind of transaction in futures market. Okay. Now, Cme Group, formerly Chicago Mercantile Exchange, okay, Chicago Mercantile Exchange, CME Group, is by far the largest currency futures market. So the website looks like this, Cme Group. You can Google search it and have some fun. The world's leading and most diverse derivatives marketplace. If you're interested in commodities trading, right? For example, not just a few foreign exchange, but oil kind of things, gold, silver, or wheat, all kinds of commodities are traded over here. 상품 거래, right? 상품. The Korean terminology 상품 is like a bit misleading in psychologically. I mean, 상품, what kind of product? Product? No, commodities. Okay, commodities. So the physical location of CME, it looks like this. The building, you see the Sears Tower far behind, right? The black building. But in front of it, you have the CME. Inside the CME Group, the picture looks like this. Open outcry market is there, but mostly nowadays it is done with machines, right? So this will be a smaller portion of the trading in commodities market. And as you see, how do you say this? All finger language, right, is going on, so that the buyers and sellers will be able to punch in those deals, right, quite speedily. And actually, I suggest you to watch the movie called Rogue Trader or Rogue Trader. The Rogue. Is it right? Rouge or Rogue Trader. Okay, Rogue Trader. This is a movie about Baring brothers, how they were screwed up by a trader called Nick Leeson in Chicago, not in Chicago, but in Singapore, right? In the movie, you're gonna be able to see the the derivatives trading taking place in Singapore exchange, okay? And then how things are done in the open outcry, okay? Quite an interesting movie, I think. Okay, now this is a open outcry system. This is a very aggressive, how do you say, those guys who are, fighting for buys and sells and openly, crying out those numbers, right? These guys actually in 1990s and 2000s, right? 신영석 교수님, right? Mr. 신영석 once told me this story that at one point, okay, those guys, one of the guys, going into this pit, right, and then fighting it, raising their hands and then shouting their numbers. One of the guys had heart attack, and then he could not even fall down, but he was stuck in the middle, like standing, and nobody else was taking care of him. So much so that he was dead, standing. Nobody was taking care of him until the end of the whole day's session. So guess how much painful it must be. And guess how much of a fierce competition going on over there. So much so that you don't even care about what the hell is going on with the right next person. Quite inhumane, okay, place. That's, a reality, okay? That kind of accident happened before, okay? Those bankers, those CEOs, okay, in the Wall Street, they are the guys who survived that kind of fierce competition. So you can pretty much picture what's in their mind, okay? Now, but that's how people make money, okay? That's the reality. What can we say? The everyday life is like a battleground. Seriously, a battleground. Oh my God. Okay. Currency futures markets, right? The Cme Group, right, is by far the largest currency futures market. Singapore Exchange, SGX, offers interchangeable contracts. And then there are other markets, but none are close to CME and CIMEX. This part of the trading, okay, the chapter that we are covering right now, if you go to investment banks, it is covered by the FICC division. Okay, typically nowadays they call it FICC. What does it stand for? Fixed income, commodities and currency trading. Okay, commodities and currency. Fixed income means what? Bonds, right? U.S. Treasury bond or corporate bond kind of things, but usually government bonds, right? Fixed income. Why is it fixed income? Because they pay fixed coupon, okay, every year, okay, every quarter. And then commodities. I told you commodities. What? Like copper, gold, and oils, right? Crude oils. Who invested in crude oil these days, right? Good luck. Anyway, and then commodities, wheat, rice, all these kind of things, which means the crazy asset, right? Crazy assets, highly volatile. And currency, of course, it is also very volatile. Predicting it, impossible. Okay, market efficiency holds true over here. That's why it is impossible to predict. Okay, because all the information gets priced immediately, so much so that there is nothing much left to predict anything in the first place, which means the volatility goes crazy. Okay, FICC. Anyway, talking about these Singapore Exchange, right? We've been there before. Yeah, this is our global career tour of Sungkyunkwan University, Global Business Administration guys, right? And then and 이준원 이사님 was kind enough to lead us there and then gave us a wonderful introduction about this exchange, right? And then some of you are here, right? 민성이, 송민성, okay? 박재민, where are you, right? How are you guys doing? Okay, you guys have to work hard. All right. Anyway, other guys as well, right? I wish everybody was there too. Anyway, but Singapore Exchange, right? it says Asia's broadest range of listed futures, right? If you believe Korea is the largest country in Asia, no, come on, wake up. In terms of finance as well, right? More diversified opportunities are there in Singapore, and they have access to all these kind of different markets much more. Um, Futures, right? They have access to FTSE China Index, MSCI China Index, Nifty 50 India, and MSCI India. All these things, right? Listed futures are in Singapore Exchange. Anyway, um, so if you happen to get a job in KRX kind of exchanges, right? Think about your competitors, international competitors. You will be competing against Singapore Exchange to host this kind of new products, futures products, kind of things. Widen your scope, please. And then currency futures market, well, all right, let's go. There are other markets, right? Expiry cycles, expiration date is a futures market. March, June, September, December are typical expiry dates for these products. 369, 369, 369, 369. It comes from this, I guess, right? So many people drink anyway in finance. Anyway, so the delivery date is the third Wednesday of delivery month. I'm not going to test you on this one, but it's just mechanics and institutional details. The last trading day is the second business day preceding the daily delivery day. Okay, now Exhibit 7.3 in your textbook, go ahead and read it. And CME Group's currency futures contract quotations are shown as an example. And what you see on the horizontal axis is opening price, high price, and low price, and settlement price, which is closing price. And then change from the previous day, and then open interest, right? How many contracts are done in that day, on that day. And then what you see on the left-hand side column is that currency futures kind, which is first one is Japanese yen in CME Group traded. And you see June and September maturity futures contracts are there. And then Japanese yen, the standard unit, okay, well, is, how much is it? 12.5 million Japanese yen per contract. And then dollar per 100 Japanese yen unit are shown over here. Okay. Remember, Korean won. It has to be dollar per 1,000 Korean won. We have many zeros, right? Otherwise, you're going to screw up your eyes. Japan, they have one less zero, so that's why 100 yens, right? Anyway, then Canadian dollar futures unit is shown over here. And then Canadian in the unit of one contract has 100,000 Canadian dollars, okay? And then dollar per Canadian dollars are shown over here, okay? And then, so 1 Canadian dollars is 77.24 cents US dollars terms, right? In June maturing futures contract. That was opening price. Anyway, British pound is also shown over here. The standard unit of British pound, 62.5 thousand pounds. And then the way we show it is dollar per pound is shown over here. Okay. And then the next, you will see Swiss franc, and then Australian dollars, and Mexican pesos. All these things, right? June, September are shown. And then Euro, right? And then Euro, Japanese yens, all those are shown over here. And then the next one is Euro to British pound and Euro to Swiss francs, like cross exchange futures are shown, okay, in standardized manner. Now, With futures contract, we have daily resettlement of gains and losses rather than one big settlement at maturity. So every trading day, if the price goes down, the long pays the short. Okay, price goes down, it's bad news for the long holders, right? They have to pay to the short holders. If the price goes up, on the other hand, the short pays the long, right? After the daily resettlement, each party has a new contract at the new price with 1 day shorter maturity. So day by day, it's resettled, right? Consider a long position in a CME British Pound futures contract. It is written on 62.5 thousand British Pound and price is quoted in dollars and cents per pound out to 4 decimal points. The minimum price increment is $0.0001 per British pound or 0.01 cents per British pound. And then if you multiply this by 62.5 thousand pounds, you will see that it corresponds to $6.25 per contract. We went, let's say, take an example. We went long the futures contract at the price of $1.3 per pound. Okay. At initiation of the contract, the long post an initial performance bond of 1625 US dollars. How do we calculate that one? Well, you guessed it right, I think, right? So 62500. Can you see me? Yes. And then times 1.3 dollar per pound, okay, times what? 2% will be 1625. Yeah, 25 US dollars. Can you check it with your calculators? And then I got it here correctly. Yes. All right. The maintenance performance bond is $1,300. This one is your initial performance bond, but their minimum balance is $1,300 level. Okay, you are standing over here, and as time goes by, it may go up and down, but you don't want to hit this one. Bing. Okay, you don't want to hit this one. That time, the exchange CME will call you. 감당하실 수 있겠습니까? And you will have to set up a new performance bond, okay? Or you clear out, right? Each day's losses are subtracted from the investor's account. Each day's gains are added to the account. In this example, an initiation or the long post, an initial performance bond of $1,625. The maintenance level is $1,300. If this investor loses more than 325, which is this difference, right? Which is this difference, okay? He has a decision to make, okay? He can maintain his long position only by adding more funds, okay? And if he fails to do so, his position will be closed out with an offsetting short position. Okay. Now, day by day resettlement. How does it work? Here's an example. Over the first 3 days, the pound strengthens, then depreciates in dollar terms. So the first day it moved up to 1.301. Okay, dollars per pound. Now, the second day, the pound value depreciated to 1.298. And the third day, even further, 1.2948. Okay? So, day by day, you can calculate the gains versus losses. And then, according to this, based on these gains and losses, your account balance, right? Your performance bond account balance will change. And then see if this account balance hits $1,300. Okay, that is the point when you get margin calls. Now, The first day, okay, the gain is $62.5 in your performance bond account. Okay, how do you calculate this one? Well, simply based on your 62.5 thousand British pounds, right? Multiply the change in the price of pound in terms of US dollars, which is from $1.3 per pound to 1.301 dollars per pound. So 0.1 cent per pound increased. So you multiply this guy by 62.5 thousand pounds. So you get $62.5. And this goes into your performance bond account. So it have to add this guy to your initial performance bond, 1625. So in the end, you will get $1687.5 in your account. The next day, what happens? Well, the British pound falls. Okay, Boris Johnson was there, maybe. Okay, bad news. Maybe, I don't know. So the British pound goes down with the same mechanics, right? From this guy to that guy, you decrease. Okay, so there must be a decrease in your pound price. Multiply this by 62.5 thousand pounds, then you will get 187.5 negative dollars, right? And this will erode your account balance, okay, from 1687.5 to 1500. Okay, this is exactly the difference. The third day, what happens? Well, the British pound fell even further to 1.2948, and then accordingly, starting from this to that, going to that, you calculate the loss. Okay, loss, which is 0.0032. Okay, and then multiply that by 62.5 thousand pounds, and you will get $200 of loss, and it will hit or erode your account balance 200 starting from 1500. Now you hit 1300. Bam, 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 margin call, right? You get the phone call maybe, or warning message, right? You want to keep the account or clear off, right? Now, the next, adding up together, right? At the end of this adventure, you have 3 ways of computing gains and losses. In the end, you will get to the same result. 3 different ways. 1, sum of daily gains and losses, as I have gone through. Okay. In the end, you will have minus $325. Second way is contract size times the difference between initial contract price and the last settlement price. You just have to look at the initial point and last point and then multiply it by the contract size, negative 325. Number 3, ending balance on the account minus beginning balance on the account adjusted for depositors or deposits or withdrawals, like this. Right, so ending balance, right, of your performance bond versus your beginning balance. So you will get the same number anyway. Okay, which way you go with, it's up to you. Now, currency futures, generally it's just really mechanic, right? You just have to multiply those numbers in detail. Don't lose thread, right? 정신줄 놓지 말고, right? Just you have to be precise in your small numbers. All right, currency options, right? I'm going to go through the basics of the options together with you so that we will be on the same page, right? Whether you took derivatives class or not, it does not matter, right? I want you to be ready for this one. I find that some of the international finance courses, like previously taught international finance. They didn't even go through this part. Or other schools, 고려대학교, right? Or other schools, international finance, they sometimes don't cover this, right? But I want you to be well versed in options, okay? Because you are my student, right? And then, all right, option gives the holder the right, okay, but not the obligation to buy or sell a given quantity of asset in the future at prices agreed upon today. So call versus put is there. Call options give the holders the right but not the obligation to buy a given quantity of some asset at some time in the future at prices agreed upon today. Put option is the other way around. It is the right to sell. It gives the holder the right but not the obligation to sell a given quantity of some asset at some time in the future at prices agreed upon today. Now, currency options. Why do we need this, right? Why do we need to think about study currency options? Well, put yourself in the shoes of CFOs of some corporations. Hyundai Motors, for example. Export companies like Hyundai Motors, CFOs, okay? You're supposed to receive $1 billion next month from US buyers. What would keep you awake at night? Okay? Aren't you happy to receive $1 billion right? Next month. But still, you may not be able to sleep well at night. Why? What if US dollar value goes down too much until next month, all of a sudden? Okay? You need some downside protection indeed. Okay? So in that case, if you have put option on this $1 billion, then you will be safe and sound and say, okay, I can sleep well. Why not just go forward contract or futures contract? You may question. Okay? Forward or futures only lock in the FX rate itself. Okay? Put option guarantees, on the other hand, it guarantees that the value of US dollar will not be less than the strike price, while allowing the company to benefit from any favorable exchange movements. Okay? So it's like an insurance. You need to pay the insurance premium upfront. That's the problem. Forward and futures contract, no, it was not an insurance contract. It was just zero-sum game. You lose, I win, and then I win, I lose, you win, and then what? There's no protection, but put option or call option, it gives you some protection. Okay, it gives you some protection, and then you can realize your benefit as the FX movement works in your favor. So the insurance premium, you have to pay it. This insurance premium, we call it put option. Okay, put option price, right? That's the thing. Put option premium, put option price, the same thing. That's not the only case, right? Let's think about importers, right? Let's say you are the CFOs of Hansung Motors, right? Who is importing Benz to Korea? Okay, Daimler-Benz. So you sold a lot of cars in Korean won, right? And then you're supposed to pay 100 million euro next month to Benz, the headquarter company in Germany. What would keep you awake at night? Okay, what would keep you awake at night? What if euro value goes up too much so that you cannot convert as much? Okay, starting with the Korean won. So you need some upside protection needed. Okay, so call option on 100 million euro will take care of you. Okay, will save the day. So why not just do forward contract or futures? Again, forward or futures only lock in the FX rate. Call option guarantees that the price or the value of euro will not be more than the strike price, while allowing the company to benefit from any favorable FX movements. Okay, so you need to pay the insurance premium upfront, which is called call option premium, call option price. Okay, and then in options, we have a lot of different jargons and then classifications. One classification is about European versus American options. Of course, there's Asian options as well, but not much traded yet. And European versus American options, well, European options can only be exercised on the expiration date, while American options can be exercised at any time up to and including the expiration date. Okay. Now, moneyness. Okay. Oh, wait. By the way, European versus American, right? European is only in the expiration date. European. American, in advance. You can do it up until expiration date. American options. Asian options. Well, it looks at the average price over a specified period. Average. European options did not care about the average, right? You have to be good or bad at the expiration date. That's it. Asian, the path matters. It's more like path dependent option, which is much more complicated to compute. Okay, the European option is the easiest to compute, and analytically or mathematically you can do it, solvable very easily. American option, it's not as easy. Okay, Asian option, terribly difficult. So which one will be easily traded, more frequently traded? Obviously, the easier one gets traded more. Anyway, moneyness, right? It's there, right? Moneyness. In the money, out of money, in the money, out of the money, and at the money, the money. Okay, why do they call it the money? I don't know. Okay, the is most difficult part of the language, English language for me. Anyway, if immediate exercise is profitable, an option is in the money. Out of the money, options can still have value. Why? Thanks to the uncertainty. And at the money, well, when the underlying asset price is equal to the exercise price or strike price, the same thing, right? Current price is equal to exercise price, then we say it is at the money. Okay. We need a diagram to talk about this. We're going to get back to we'll get back to this moneyness issue later on. And then Philadelphia Stock Exchange allows you to buy and sell currency options, right? PHLX, Philadelphia Stock Exchange. Now, this exchange was taken over by Nasdaq OMX Group in 2008. Then the options, right? Options. Is it frequently traded like this in open exchange, or is it more traded in over-the-counter OTC based? Okay. The answer is OTC dominates in options transactions, right? It's more tailor-made. Okay. Options is traded in exchange. There must be a lot more standardized. You can see that, right? Just like what we talked about in futures versus forward market. Options, they are more traded in over-the-counter market. Currency options are primarily traded in OTC market. Minimum transaction size is greater than or equal to US $1 million. Average trading volume, okay, average daily trading volume, is 254 billion US dollars in 2016 in OTC market. Okay, exchanges traded in exchanges. The amount is a fraction of it, and typically European style options are traded. Okay, and then currency unit is shown over here. Currency options, right? There are some currency options related to Australian dollars, and that the contract size in this exchange is 10,000 Australian dollars, and then British pound, Canadian dollars, and euro, Japanese yen. Well, euro, 10,000 euros, right? About 1,000만 원 돈, right? New Zealand dollars as well, and then Swiss franc also, okay? In exchange, right? Those are standardized products, and then the trade size itself is very small. Whereas the minimum transaction size in OTC market is 1 million. Okay, 1 million, 100 times bigger. Basics of option pricing relationships at expiry, right? Maturity date. On the maturity date, what's the value of this option? Okay, 만기 때, right? Not before, but on the day of maturity. At expiry, okay, an American option is worth the same as a European option with the same characteristics. So, if the call is in the money, okay, it is worth what? Let me draw a diagram over here. Here, can you see it? Okay, good. Yes. All right. So, what you have on the horizontal axis is the value or the price of underlying asset. Okay? Horizontal axis. Vertical axis is profit or loss. I'm drawing it in 2D, right? 2 dimension, right? X and Y. Okay, this is not time. I'm gonna draw 3D later on, where we're gonna have time axis. Okay, but this is on the day of expiration, so that you don't need any time dimension on this day. Okay, this is the end game. Okay, so at the end of the maturity, your underlying asset value can start from 0 all the way up to infinity. Okay, and then depending on your contract of your options, there must be some exercise price. Some people call it exercise price, some people call it strike price, and then some people represent it with E for exercise price or K for strike price, right? X sometimes. Exercise price. But anyway, who cares? I'm going to delete this one. Exercise price. Call option. Without thinking about any transaction cost or option, the premium that you paid, okay? The premium, you must have paid some premium to buy this call option. But let's forget about it. Treat it as 0 right now for conceptual understanding, okay? Purely thinking about the payoff coming from this option, okay, works like this. If your underlying asset value is below the strike price, do you exercise this option or not? The answer is don't exercise it, so that the value of your option will be 0 up until exercise price. If your underlying asset value is greater than this exercise price, what do? Exercise or not? Exercise it. Strike it at the strike price. And then what? Let's say your asset price or stock price is over here, ST. Okay? Then what? You exercise this option so that you buy the stock at cheaper price, at exercise price, and turn around and sell that stock at the market price of S. Okay? Buy it cheaply and turn around and then sell it expensively. You get profit over here. So that's this guy. I would say 45 degrees line. 45 degrees line. Okay? And then this has to be E minus, has to be S minus E. Make sense? Yeah. Shall I say it S sub big T because this is big T means maturity, right? The big time, okay, big T minus E, right, would be this, right? And this one is just 0, right? So your call option value on the maturity date will be maximum of S sub t minus E or 0. Either of these two, which is more beneficial to you. Okay, this is it is protecting you. This is protecting you. Okay, and this gives you some advantage as you wish, right? On the other hand, right, that's what you see on this slide over here. Hello, right? And then put option. Well, how does that work? Well, put option. I'm going to draw a diagram. Draw a diagram again. Okay. Instead of this guy, let me draw a put option. Put option using red line. Okay. Put option. Okay. Let's say you have the same strike price of E. Okay. Based on the same asset, the put option gives you the right to sell this asset at a strike price. So if at the end of the day, if the asset price or the stock price is bigger than the strike price, would you exercise the put option or not? The answer is no. Why would you exercise it? Okay. Given that you can sell it for higher price, current price, why would you choose to be able to sell it at a lower price? Are you stupid or something? So it will be like like this, 0, 0, 0, 0, 0, 0, 0 over here. Okay. On the other hand, if the stock price is below the exercise price, like over here, let me play this over here. Okay. Would you exercise this put option or not? The answer is yes. You are able to sell your stock at a higher price than current price. So why don't you exercise your option so that you buy low and sell high, so that you will have a gain. 45 degrees line. Okay? Again. 45 degrees line, and this one over here. Okay, this will be E minus S sub t. That's S sub t. Okay, so the put option will be a maximum function between E minus S sub t and 0, whichever gives you more, whichever suits you, okay, to maximize your profit. Okay, you can choose it, maximum function. All right, so you have those things over there in your screen, in your slide. What does that sub AT and sub ET means? Well, A means American and E means European. Okay, are they the same? Yes, on the day of expiration, on the maturity day. Okay, but before maturity day, the price of these options will be different. Okay, I'm not going to ask you about that. That belongs to financial engineering master's degree or PhD degree. Okay, if you're interested, go ahead and do it, but right now this is not. And then put option, PAT, PET, the same thing. American option or American option or European options, right? By the way, CEO compensation, the CEO compensation. Well, a lot of the CEO compensation is made through this call option on their stock price, right? Those Elon Musk, right? Or Elon Musk or those famous CEOs, what would you say? Those guys will have their call option upon their own stock. the company's stock. So much so that when the company's stock value goes up, when price goes up, they exercise this option and then sell it at the market price, buy it at the lower price and sell it at the higher market price, right? So then they can cash in their benefit, right? Like that. That's CEO's call option. And that CEO's call option, okay, is that European option or American option? Well, it is American option. Why is that American option? Well, typical CEO compensation contract says that once you get a CEO option package, it lasts for about 7 years to 8 years. Okay, options that are traded in these exchanges, right? It matures in 3 months or 9 months or 6 months or 1 year. But the options compensation to the CEOs, it lasts for about 7 to 8 years. Very, very long contract. And it gives them the right to exercise it, not just at the end of this 8th year, but they can exercise this call option at their 5th year onward, so that 5, 6, 7, 8, for 4 years they can choose to exercise or stay until the end. Every day they have this, right to exercise it. That's American option. Okay, that's an interesting one. Number 2, CEOs. Why do they have 8 years of? 5 year, by the way, 5th year, or 4th year, 3rd year. I don't know. It depends on the compensation contract that can negotiate it. They can negotiate, but the important thing is it has American option features in it. Number 2, why does it last for 7 to 8 years? First of all, to make the CEO more long-term oriented instead of myopic or short-term oriented. Okay. Number 2, their tenure, the CEO's tenure is much longer in the United States. Average 7.5 years or 8 years. So it matches like that. Okay. And in contrast, the average tenure, 임기, okay, 임기, average tenure of Korean CEOs, how long would that be? In Samsung or whatever, LG, their tenure on average 3 years or 2 years. Which country do you think will be more long-term oriented in terms of investing? Korea versus America. Other things being equal, American CEOs have more incentive to be more long-term oriented in that sense, because the tenure is longer. And the CEO's tenures, right? Korean CEOs 2 years only. It's just they are working like a robot, or they are trying a robot, or they are, how do you say? If they are on their own, then they will try to maximize the stock price in the short run so that they can demonstrate, oh, in the 2 years that I worked, my stock price increased by like 2 times or something, 3 times. So much short-term oriented you can become. Isn't Korean companies more long-term oriented than American companies? Yes and no. Okay, yes and no. No, in the sense that the CEO tenure is very short and it's like a 군대, like military service, like taking turns. So much so that you finished your term pretty fast. Please get away so that I could do that. The next younger guys can go there, right? Every 2 years we've been doing that, replacing. Why do you stick your butt over there? Get the hell out of there, so that they will, push him out. Okay. In that case, they work like a robot, right? and then they have to be like not just like a robot, but also have to be more short-term oriented. During my short tenure of 2 years or 3 years, I did this drastic things, and the next guy comes in and say, during my 2 years of tenure, I did on other things, and it turns out the previous guy's projects were crazy, so I just dumped everything and then moving the company from one direction to the other direction in a drastic manner in a short 2 years, 2 years, 2 years, 2 years, right? Like that. And the company goes nowhere. Why is Korean company more long-term oriented in that? Why do people call it the Korean companies can invest in more long-term oriented fashion then? Is a big question. Okay, given that the CEO's tenure is like 3 years or something, 전문 경영인 kind of things. Well, it goes back to who is really controlling the company. The guy who is controlling the US, the guy who is really controlling the company is the CEO who is doing that, and he's taking a long duration in their tenure. In Korea, the CEO is like a robot. I said, who is controlling this robot? Well, primarily the founding family. Okay, founding family, the royal family. Okay, they don't go anywhere, so that's why they are able to go give you the direction in the long run. Samsung Electronics, 이건희 회장님, right? Like 마누라와 자식 빼고 다 바꿔. Like you have to change everything except your wife and your children, and then go into one certain direction. We are dead or alive. We have to be excelling in this semiconductor business, and then digital convergence will happen. The cell phone will be a computer kind of things. Create something like that. And in 20 years they were doing that. Okay, the CEOs got changed over time, but the owner family has been there. That's a positive side story. Okay, negative side is like what I said. If you don't have this kind of solid guy in control, okay, with this solid mind, sound mind, 제정신인, right? If you don't have this kind of 제정신인 guy in your founding family, you're in trouble, man. Can screw up the company very differently, and then all the CEOs with the short tenures, right? They can screw up the company very differently. Every 2 years, you change from 좌파 to 우파 like crazy. 우파 to 좌파. Okay, anyway. Good. So that's about the options. Now, a little bit of digression, I guess, but important for your international corporate finance. Cme Group trades American style options on most of the currency futures contract, European styles as well. Underlying asset is a futures contract on the FX, not the physical currency. One futures contract underlies one options contract. Expirations, again, 369, March, June, September, December, and 3 additional months, right? Here, this is options on futures of currencies, like derivative of derivative. You may feel it very complicated, but it's not that terrible. You will see the reason in a couple of slides later. Options on currency futures behave similar to currency options because the futures price converges to the spot price as the futures contract nears maturity. Okay, now currency futures options, well, exercise a call option on currency futures. Then what happens? Well, you get long position in futures, and then you get the price difference between the futures and the strike price on that futures. Okay. Number 2, exercising put option on currency futures. Then what happens? Well, you get short position in futures. Okay. And then plus exercise price minus futures price at that maturity date. That's what you'll get. Okay. 2 components in it. Wait, you will say. Currency options versus currency futures options. Wow. So confusing, you may say. The same strike price and the time to maturity. Okay, if we have it, then what happens? The payoff from a European call option with a strike price K must be maximum between S sub t minus k and 0, where S sub t, big T, is the spot price at the option's maturity. And then the payoff from a European futures call option with the same strike price is maximum of F sub big T minus K and 0, where the F sub big T is the spot price at the option's maturity. It's the spot price of the futures price, right, at the time T. Okay, if the maturity of the futures contract and that of the options are the same, then S sub big T should be equal to F sub big T, and the two options are in theory the same. So that's why. And if they are going to be in theory the same, right, why don't we use whichever is more convenient? Why is currency futures options rather than currency options are traded? Well, analogous question is this. Analogous question. Crude oil versus oil futures. Which is easier to invest? Well, to buy and sell crude oil itself, you need these, which is oil tankers and then oil reserve in your land, right? All these kind of storage spaces. You need all these things. But to buy and sell crude oil futures, you need just a trading desk, some, office space, computers. That's it. Okay, and with your minimum capital, you can do it. So, which one will be more frequently traded? The physical oil versus oil futures. Oil futures. Futures contract is more liquid and easier to trade than the underlying asset. Okay, underlying asset. Futures price is known immediately from trading on the futures exchange. Spot price of the underlying asset may not be readily available, and derivatives like futures and forwards and options, we call it derivatives is price discovery mechanism. Okay, and futures in this sense is better for you in discovering the real price of it instead of the physical assets price itself. Very interesting. And then exercising of futures options does not lead to delivery of the underlying asset. Okay, futures contract gets closed out before delivery, right? Lower transaction cost for futures options than for currency options. So that's another reason why futures on currency options, options and futures of currency is quite popular. Now, basic call option profit profiles. It looks like this. If the call is in the money, it is worth, as you see, this amount over here, S minus E, right? If the call is out of the money, it is worthless, and the buyer of the call loses his entire investment, right? Now, here in the diagram, we are considering the initial price of options when you purchase it, okay? The C0, right? So, in the money, out of the money, typically we say it based on your strike price, okay? In the money, out of the money. But when whether you break even or not, well, that incorporates the option price that you paid, okay? So that's how it works. Consider a call option on 10,000 euros. The option premium is 25 cents per euro. The exercise price is $1.5 per euro. The option cost $2,500 today, and the break-even exchange rate is $1.75 per euro. 1.75. How does that? Where does that come from? Well, this guy plus that guy should be this one. Okay. Good. Right. Let's move. If the put is in the money, it is worth exercise price minus S sub big T. The maximum gain is E sub E minus P0. Okay, E minus P0. Well, what does that mean over here in this diagram, right? Just like before, in the call option argument, we are incorporating the initial purchase price of this option, which is put option P0. Okay, minus P0 should be your initial cost. If the put is out of the money, it is worthless, and the buyer of the put loses his entire investment, right? In the money, out of the money, again, it is determined based on the strike price itself, but whether you are break even or not, okay, you have to consider the P0, okay, initial investment. Now that's that. If we move down, consider a put option on euro currency, which is 10,000 euro. The option premium is 15 cents per euro. The exercise price is $1.5 per euro. What is the maximum gain on this put option? Which is 1.5, okay, 1.5 minus 15 cents, which is your initial purchase option premium, and then times 10,000 euros, right? So this should be your maximum gains, which is this guy over here or that guy, because this is 45 degrees line, okay? Now, at what exchange rate do you break even? Well, $1.35 per euro, which is because $1.5 minus 0.15 should be 1.35. Make sense? Good. Now, market value, time value, and intrinsic value for an American call. The red line shows the payoff at maturity, not the profit of call option. And line shows the payoff at maturity. Note that even at the out of the money option, it has a value which is time value. This green line part, market value, and long call. And then this is again the payoff diagram of call option. Okay. Now let me take you back to this diagram over here. Okay, call option. So I'm going to delete this red. I'm going to draw this picture again. Okay. Draw this picture again with black marker and expand this screen. I'm going to draw a 3D plot, okay? 3D plot. Let's see if you can make sense out of it. So here is the profit and loss, and here is the stock price or price of underlying asset, okay? So this one will be your underlying asset value on the day of maturity, T, big T, as you see, big T, right? And on the day of this maturity, the call option with a strike price of E will look like what? The payoff diagram will be kinked hockey stick like this, 45 degrees line. You know this already, right? So this is 0, and then profit and loss, right? We are ignoring the initial purchase price of this call option. Forget about it, okay? And then here I introduce time, okay, time dimension, because we are going to have to think about this option value before it matures, right? 3 months before it matures, 1 month before it matures, or 1 year before, right? How much should I pay for this option over here? Okay, the option value. We'll have to think about it. So if I draw a time axis in a 3D manner, time. All right. And then, so you see 3D dimension diagram over here, right? And then let's say you are standing over here 1 month before. This is time point T, time point 0, right? Here you can draw another equivalent diagram like this, parallel and parallel like this, right? And similar exercise. Price. Okay? So maybe this is too bright. Okay. So it is getting clearer, right? Now the question is, right? We have, let's say, we have 1 year to go. 1 year to go. And this call option, we have it right now. Exercise price is determined, predetermined already, right? And then today, the stock price may be somewhere over here, okay? Some stock price, let's say over here. How much would this option be, okay, would be worth? Well, you have this 45 degrees line, which is parallel to this, right? Parallel, okay, the same parallel to this, so that you may think that this, right, S, let's say S small t, this is small t time, right? Small t time, not big T, but small t time, so that the options value will be S sub small t minus E. Is that right? Is a question. Okay? Today's stock price is S sub t over here. Yes, it is greater than the exercise price, but does that mean this option is worth, okay, is worth exactly as S sub t minus E? Is a question. Why is it not? Okay, it is not. I'll tell you what. It is not the same. Okay, it is not. It has to be a bit bigger than this, a bit bigger. Compared to, you see it? Right. A bit bigger than S minus E. A bit bigger. Why? Because over the next year, there is a randomness, so that your stock price may end up in very, very high manner, right? Also in bad situation too, but there's a likelihood, okay, that it will be better than current price in the future. Okay, so there is a probability related to it, so that you have to get some benefit out of it. How about an option? How about this situation? Your current stock price is S sub small t over here, miserably below exercise price, deep out of the money option. Okay, deep out of the money option. What's the option value? Okay, what's the call option value today? Okay, is it going to be 0? Is it going to be 0? Oh, this is deep out of money. Okay, so it's lower than exercise price. 1 year before maturity, is it going to be 0? And the answer is no. Okay, no. The value of this option, call option today, will be slightly positive number. It will be profit, right? Will be somewhat greater than 0. Okay, some positive number will be your option value. Why? Why is the case? Because it is not matured yet. You still have 1 year to go. God knows what's going to happen, right? Did you know this kind of coronavirus will happen in the beginning of 2020 when you purchase any kind of the medical stock or medicines, pharmaceutical stocks, or some delivery stocks, right? delivery hero kind of stocks. God knows what. There's such a huge randomness over the next period. So there is a huge chance, there may be some chance that this guy will end up in the money. Okay, so this is a three-dimension plot that I'm in your imagination, right? Three-dimension plot. As time goes by, this stock price, 쥐구멍에도 볕들 나온다 is in Korean terminology. Even if you are in a terribly miserable situation, as long as this is call option, as long as this is on your underlying asset has some randomness, God knows where you will end up over the next year, right? We don't know. So there is a chance that you will end up in the money. You will end up in the money at the end of 1 year. So much so that incorporating that probability of being positive, the value of call option today will be always something slightly positive. Okay? And then, so if you draw a diagram or a graph of option value, call option value especially, before the maturity, let me draw it with brown color, okay? Brown color, or does it look the same? No, not this brown color. Let me draw it with hot pink, yes, not black pink, hot pink. Then the option price before maturity will be something smoothly greater than this hockey stick. Okay, something smoothly greater than this hockey stick, right? And as we move down the road, it will converge to this kinked line. Okay, as maturity gets in, there's no chance, less of a chance. Okay, so here's an interesting phenomena. Okay, let me wipe off all these things, right? Except for this smooth line, right? Smooth line. Notice that over here. Da 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 da. Right. Okay. Right. Now, with this three-dimensional thing, call option value diagram, right? Call option value diagram. Now, what do you have? The more time you have until maturity, the option value, call option value will be bigger, because there is more uncertainty you can allow in, right? Put option the same way. The longer maturity you have, the put option value will be higher because there's more uncertainty with it. Where if you are option traders, the risk is your friend. You're living with the risk, right? More uncertainty, more flexibility for you, okay, for option traders. So option value will be bigger. Longer maturity, higher value. How about the volatility of the stock, underlying asset? If there is more uncertainty with it, the option value, put option, call option, both of them, the option value will go up, not down. More uncertainty, higher value for options. Then call option, put option, right? Okay, the intuition is very important over here. So call option premium increases, right? As the spot exchange rate increases, right? Why is that the case? Because imagine this call option over here. You're standing today before maturity, right? Before maturity, as the underlying asset, which is spot exchange rate, increases, then the profit that you can expect is bigger. Okay, you are more likely to end up deep in the money anyway. So call premium increases, and then put premium, okay, increases as the spot exchange rate decreases. So for a given put options that you have, right? If the spot exchange rate goes down, you are in the money for put option, okay? And even more so if the underlying asset is more in trouble, okay? So that's the first bullet point. Second bullet point, your call premium increases as the strike price decreases. So call premium, call option over here, if the strike price decreases, and then there will be parallel movement of this graph, and then for a given spot exchange rate or underlying asset value, your value of option increases, right? And then in a special case, for example, in the stock market, stock and call on stock, right? When the call options strike price is zero, okay? When the call options strike price is zero, that's going to be the same as your stock itself. Make sense? Yeah, it's 45 degrees line anyway. 1-to-1 matching will be there, right? Anyway, so that's that. That's for corporate finance purpose. And strike price increases for put options, right? For put options, as strike price increases, you're deeper in the money. Okay, your your profit will be bigger. The put option value will be bigger. Your own country's interest rate increases. Well, as your own country's interest rate increases, your call premium increases. This is because what? The discount rate effect. Okay, discount rate effect. And then foreign currencies interest rate decreases, then your call premium increases. Foreign currencies interest rate works like a dividend yield in regular option valuation technique over there. Foreign currencies interest is like if you interpret the foreign currency as a stock, right? There may be some dividend coming out from that stock called the foreign currency. That dividend yield will be equivalent to that country's interest rate. Okay, so that's the relation that we find, and the foreign currency's interest rate decreases, and it helps. The call premium. Okay, because that's related to the dividend 배당락 kind of the drop of stock price on the day of the dividend declaration, right? So that the spot price goes down on the dividend declaration, which does not help call option at all. So you want less of a dividend yield, okay? So to help you better higher call premium. Anyway, that's the way I interpret it. And then more time is left and more volatility, higher call option price and higher put option price commonly. This is exception, right? The others, call option premium, put option premium moved into the opposite direction, but commonly they like volatilities and uncertainties, right? So that's one more thing I want to make sure. And then the concepts in options. There are a lot of things, right? The 파생 상품론, you need to take those class specifically, right? To master all these things, right? 신영석 교수님 is doing the investments, right? Go ahead and take it. He used to work as a number 2 guy in KB증권, right? 부사장님, and then Wharton PhD, right? Amazing guy. His English is even better than me, and in terms of proficiency and elegance and all these things. Fantastic guy. Go ahead and take his class. Number 2, 김다혜 교수님, right? 파생상품론. She's got a PhD in KAIST and then got a professorship over here. She's an amazing genius, right? And then she's mastermind of this kind of mathematics and then mathematical finance. So go ahead and take her class. Here in my class, I'm going to go through in like a hand waving way, relatively. But those concepts over here in derivatives, let's just read it off a little bit. Call, put, long, short, and then currency option and currency futures options and martingale. Oh my God. That's a concept you're going to learn in Masters in Financial Engineering or 김다혜 교수님's class, right? And in the money, out of the money, at the money, right? We talked about it, right? So talking in the call option framework, in the money, out of the money, and at the money. Okay, at the money, right? And then binomial option pricing model, we're going to go through it. No arbitrage condition or assumptions is very important over here. No arbitrage, what does that mean? Well, the two securities that pay the same in different states of nature in the future, they should have the same price today. Okay? So much so that there is law of one price of going on, but if the law of one price breaks down, there will be arbitrage opportunities. But the market that we talk about allows no arbitrage. Okay, so much so that there will be law of one price abided by. Okay, and then hedge ratio, right? This kind of concept will be discussed. And then Brownian motion. We are not going to talk about Brownian motion today or in this semester, but that's something deeply related to this financial engineering and then derivatives class, right? Brownian motion is randomness process, right? You can think about it as normal distribution, standard normal distribution. That generates the random numbers generated by standard normal distribution in terms of return in a continuous time, stock returns or whatever. Okay, so that you will see a random movement in the stock price associated with it. Anyway, replicating portfolio and then the risk neutral probability. We're going to go through that risk neutral probability today. And then Black-Scholes model, yeah, just to scare you off with this. At the end of the chapter, we have to go through that part. But we are not going through Ito's lemma or anything to derive those Black-Scholes models, right? Black-Scholes-Merton model kind of things, right? But that's something you need to familiarize yourself later on in your career if you are interested in this derivatives market. And then European option, American option, Asian options, and exotic options like Kiko kind of things, barrier options. We're not going to talk about it in much today or in this class, but just keep that in mind. That's something coming up in your career. Option pricing models, right? We have two different classes of pricing models. One is discrete time models and two is continuous time models. Discrete time versus continuous time, what do you mean? Well, discrete time is like, the way I understand it is, you have very simple world. One day and then 1 year from now. Just analyze the timeline in two different time points, discrete time points, okay? And then different states of nature in discrete way. One boom time and the other bust time or recession time. Okay, 2 time points, 2 states of nature tomorrow or in the future, or 2 states or 3 states of nature. You can think about it, but 2 states of nature is troublesome enough for you. Okay. So that's discrete time model. Continuous time is like involving this Brownian motion. every millisecond you are continuously compounding. And then if you look at the Samsung Electronics stock price chart, right, it changes every millisecond. Okay, so many people buys and sells at different prices. It moves like crazy, and the movement is like a Brownian motion, which is the diffusion. Once you, I mean, there is a, assuming that there is a water, okay, pure water, and then in your cup, okay, in your cup, like this, and then you drop one ink of black ink into the cup and observe how this drop of ink gets diffused into the water, right? The model of this kind of diffusion is called Brownian motion. And then, or somebody call it Wiener process, because the guys in the Vienna or Vienna, right? They developed this kind of model 100 years ago, right? Vienna was such a developed country in 100 years ago, so much so that they were modeling all these kind of things. Continuous time model. Black-Scholes Merton model is there, and then HJM, and then what? Heston and whatever, like all these kind of model will be there for you, but not in this semester. We're gonna just play with Black-Scholes Merton model using Excel spreadsheet, and then you just have to input certain things over there. The mathematical models are already there for you. Anyway, but Black-Scholes Merton model is scary to you guys, but what is actually more bothering is binomial or discrete time models, right? Discrete time models. It will 영혼까지 털어버리는, like 탈탈 털어 to you, or like it will bother to like crazy. Okay, here's binomial option pricing model for the first one. There we're going to use something called the delta hedging, and then the next one will be risk neutral pricing, assuming binomial trees, right? Risk neutral, what the heck? We know about risk aversion, but what do you mean by risk neutrality? Okay, for that part we need some refreshers of economics basics, and to be able to explain all these connections, I need to give you some mathematical refreshments. Okay, so don't lose threads. 정신줄 놓지 말고 follow me, right? Mathematical refreshers, right? The natural log comes in here because I need this natural log to discuss the continuous time discounting. Okay, continuous time discounting, getting the present value using this continuous compounding idea. Okay, present value, yeah, the cash flow divided by 1 plus interest rate to the power of time intervals, right? Well, when it comes to continuously compounding, every second you are compounding those interest over time, right? Then how do you get the present value of this? That's going to be bothering you a little bit. Okay, so here remember the definition of natural log E, right? Natural log E. How do we define it? Well, that's this limit of 1 plus 1 over n to the power of n, and let's take it to the infinity. The idea is this. What's the 1 squared? It's 1. 1 cubed, that's 1. 1 to the power of 10, that's 1 again. 1 to the power of infinity, that's 1. Okay, it's always 1. 1 is a wonderful number, that's why it's 1, right? Kidding. But the question becomes this. Well, what about the number that is really close to 1, yet we raise it to the power of infinity? Okay? Would it still be 1? I told you before, okay, that here 1 to the power of infinity is 1. But something very, very close to 1, right? Something very, very close to 1 from the right-hand side, right? This number over here. Let me expand this one. Yeah. 1 raised to the power of infinity is still 1. But a number that is really, really, really close to 1, and then we still raise it to the power of infinity, what will happen? Intuitive answer is like when you look at 1.1 to the power of infinity, it goes to infinity. It is infinity, right? But what if 1.0000001, very close to 1, and you raise it to the power of infinity? Does it still go to infinity? Is a question worth asking. And the answer is no, it doesn't explode, but it converges to a certain magical number called E, natural log E, which is E.718, 28, 18, 18, right? Wonderful number called E, right? That's this argument over here, right? In fact, that's not just it. That's just one special case. That's just one special case. You can think about a function. That looks like this: 1 plus x over n. Okay, and then raise this guy to the power of infinity, and that will be e to the power of x. That's what you see over here, right? And this is really, I told you before, separating the 이과생 versus 문과생, or 문송합니다 versus not, right? So let's see. Why is it useful for us, right? In finance, why is it useful for us? Well, if you borrowed a principal amount P with an annual interest rate of R at the end of 1 year, then what you have to repay is P times 1 plus R, right? The interest rate. Okay, that's just 달리 계산 is like a one-time interest, right? That's it. But if you are compounding every 6 months, right? That means in a year you have 2 periods. So compounding 2 periods. So periodical interest will be R over 2. Okay? And then you have to raise it to the power of 2 because you have 2 periods, right? So the amount that you have to repay will be P times 1 plus R over 2 to the power of 2. Okay? If you are compounding every month, what happens? Well, you just have to recognize the period you have is 12. 12 periods, 12 times you compounding. Okay? So 1 plus your annual interest rate divided by 12, and the whole thing raise it to the power of 12. And multiply it by your principal amount. The whole thing will be what you owe at the end of the year. Now, that's fun. Instead of 12 months, let's increase the compounding frequency to daily frequency, 365 days. Every day, you're compounding interest. Who does that? 일수 계산 in Korean terminology. 조폭, right? Or 사채업자, or like the loan sharks, right? They're doing this kind of things, right? Daily compounding, and later on, 배보다 배꼽이 커. It's like a interest accumulation is bigger than your principal later on. But in this case, it will not, because we start with only 12% interest rate in the first place. What we are doing is just starting with the fixed interest rate and then dividing it 365 days. So that's that. So how do we do it? Well, 1 plus R divided by 365, the whole thing raise it to the power of what? 365. Okay? And then multiply by your principal amount, P. So that's basically it. The next slide. If you have to compound every millisecond, right? Every millisecond, to be precise and scientific, every millisecond, da, 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 da. Then what happens? Well, you are just splitting the 1 year, splitting the same 1 year by infinitely many intervals, right? N divided by n, and this bring the n to the infinity. So if what you owe will be p times 1 plus r over n, the whole thing raised it to the power of n. That's going to be e to the power of r, I should have said times p, your principal amount. Make sense? Sorry for the typo. I should p. Okay, so that's that. For example, annual interest rate is 12%. Then what? Well, 12% divided by n, and then plus 1, and then raise it to the power of n, and then send this n to the infinity, right? Times p. That will be e to the power of 12%, and then times p. Holy cow! E to the power of 12%. What do you want? Well, e to the power of 0.12. Okay, decimal number. Remember that. And then your second trouble will be, how do I punch in this thing in my calculator, right? This calculator. Okay, so here what you have is of course you have to switch on, right? Switch on like this, and then clear everything, right? And then 0.12 you first punch in like this, and then shift yellow thing, and then e to the power of x over here, which is this guy. Can you see it? This one? Yeah, the key that has ln, natural log ln, but it is the shift key, e to the power of x. Then it gives you the resulting number, which is 1.1275. All right, 1.1275. Take a step back and you see what's been happening. What was your annual interest rate? 12%, right? So what you got over here is 1 plus 12% plus something more. You see that? 1.1275 or something. Okay? So you can see that continuous compounding, okay, right? With the same annual APR, annual percentage rate of 12%, you get slightly bigger percentage number of interest rate, 12.75% when you're continuously compounding, right? Money never sleeps, so that's why. Okay, slightly different, small degree, but it's going to be big if you accumulate it with a big principal over a longer period of time. If you adjust the maturity by a fraction of t, big T, okay, then what happens? Well, here 정신줄 놓지 말고, right? Like keep on, right? Don't lose thread. We do the same thing. The principal amount times 1 plus r over n to the power of n, but we one more time raise it to the power of big T. Okay, one more time we raise it to the power of big T. This is how we adjust the maturity. Okay, why? Because this is how we compound it anyway. Okay, 1 plus interest rate times 1 plus interest rate, raise it to the power of t. Isn't that what we used to do? Okay, 1 plus, this is what I'm saying. P times 1 plus r to the power of t. Okay, if it was just one annual rate, right? And then t years to go, wasn't it growing it? A compounded growth, right? That's what's happening over here. And instead of 1 plus r, just we are bringing in e to the power of r. Make sense? So that's what we are doing over here. And p times e to the power of rt. And this big T can be bigger than 1, can be smaller than 1, depending on your adjustments that you wish, right? But in typical textbook questions, it will be smaller than 1 because the option maturities that we work on is less than 1 year, like 3 months, 2 months, 1 month, that kind of things, right? So T will be smaller than 1 usually. For example, annual interest rate is 12%, but the maturity is only 3 months, so that the T should be a quarter. So hence, the formula will be like P times 1 plus 12% divided by n to the power of n, bring it to the infinity, and then the whole thing raise it to the power of a quarter. Right? So that will be P times e to the power of 0.12 times 1 quarter, and then that is going to be P times e to the power of 0.03, and that's going to be P times 1.030045. And take a step back, and you see that 3 months interest rate, okay, if we don't do continuous compounding, it will be simply 3%. But we can see that it is slightly bigger than 3%, okay, because money never sleeps compounding, right? So that's that. The next slide is another take you to further, right? This time, let's calculate the present value of some amount you get in 1 year, okay, present value, not growing, but the present value. You have a 0 coupon bond that will pay you X dollars in 1 year with an annual interest rate of R. The present value of the bond would be simply like this. X amount that you're going to get divided by 1 plus R. Yeah, that's simple and easy time value of money. Your ZCB does compounding every 6 months. So 2 times there will be compounding. Then what? You need to discount it 2 times with the periodic interest rate, 6 months interest rate. Remember that? 1 plus R divided by 2. That's going to be your 6 months rate. And then you have 2 6 months periods. So compounding 2 times, 2, raise it to the power of 2. That's what you're doing over here. Make sense? And then remember, this is present value calculation, so it is going to the denominator. And what is in the denominator? It will be simply having negative exponents, okay? Minus 2 instead of plus 2. You see that, right? This is just a nice way of scaring non-mathematical people. 문과생, scare you off, right? And then next, your ZCB does compounding every month. Okay, that's fun, right? 12 times. So periodic interest rate, which is monthly interest rate. How do we get it? Well, start from your annual interest rate. Okay, start from your annual interest rate. Divide it by 12, so you get monthly interest rate. And then how many months do you have? 12 months over there. So 12 times you will compound it, okay? 12 times. So raise it to the power of 12. That's what you're having. But remember, this is getting a present value, so it goes into the denominator over here, like this. So to scare you off, right, that denominator thing needs to have negative exponents, right, when we bring it to the regular numbers like this, non-fractional number like this. Okay, how do you say? 분수 뭐라 그러지? The rational number kind of things. Anyway, so that's that. We move down to the next slide. We are not done yet because we need to bring the natural log. All right. So your ZCB does compounding every day. Oh my God. Every day. 365 days. So divide the 1 year into 365 intervals and then compound it 365 times and then raise it to the power with negative number like this because you are getting present value. If compounding every millisecond, what is your present value of this CCB? Well, good question. Let's take n to the infinity anyway, but you're going to have a fraction like this. X divided by 1 plus r divided by n, raising it to the power of n. That seems quite familiar. And that is none other than the natural log e to the power of n, because we are just simply raising whatever n, or sending whatever n to the infinity, right? So the thing in your denominator is going to converge to natural log e to the power of r, right? E to the power of r. And remember, just to scare non-engineering guys off, whatever is in the denominator needs to have negative exponents if you're displaying it like this, okay? It will help you in our calculation later on, so wait for that one. And then if you adjust the maturity by a fraction t again, we do the same thing over here. X divided by 1 plus r over n, raising it to the power of n, and then finally raising it to the power of t, because this guy, right, the same idea, but get a present value of it, okay? And then negative exponents like this, okay? 지수 법칙 or exponent rule is there for you. And for example, annual interest rate is 12%, but the maturity is only 3 months, then t should be a quarter, and hence the present value of ZCB will be like this, right? If you do the number, you will be like what? X times e to the power of minus 0.12. Remember, it has to be decimal number instead of percentage figure. Watch out. So many people get it wrong over there and get some points off. I will take your points off, right? And multiply it by a quarter, because this is a quarter period, quarter year, right? So then we get e to the power of minus 0.03. It just tells us that it is getting a present value of 3% rate, right? 3% rate present value of x. So that's that. Now, okay. So that's our math refresher a little bit. And then another refresher that we need to go through is economics refresher, because we're going to talk about risk neutrality in this class, right? And it has to do with the concept of risk premium, okay? Now, binomial pricing of call options on stocks and pricing with delta hedging and risk neutral pricing, all these things are discussed. So for this part, we need our economics refresher. I'm going to talk about the utility function coming from expected utility theory, right? I'm drawing 3 different utility functions, okay? That represents the risk attitude of different investors. Usually we are risk averse, right? We are risk averse. Of course, the basic attitude is that the more wealth we have, the happier we are, right? So what we have on the horizontal axis is the wealth level that we have at the end of the day. What we have on the vertical axis is the utility that we realize, okay, the happiness that we feel. Can you quantify your happiness? Of course. Okay, if you don't agree, don't be a finance guy, right? Everybody in finance field and economics, right? We agree that we can represent the utility as a function of wealth and quantify somehow. It's not a perfect measure, but still. The idea is the more we have, the happier we are. The less we have, the unhappier we are. Okay, fine. So that's good. We have 3 different kinds of people. Okay, 3 different kinds of people, depending on the risk attitude. Okay, usually we are risk averse, so much so that we start from 0. Okay, let's say The more we have, the happier we are, but it decreases. Okay, but decreasing marginal utility itself is not what I'm trying to say over here. Okay, what I'm trying to say is gambling situation. As a gambling situation of coin flip, and then head I win, tail I lose. Okay, so uh, the gambling of head I win and tail I lose. Okay, so head and tail, and then we can draw a straight line. Okay, this is a utility function, but this is an expected value. Okay, expected value of this coin flip gambling. Okay, and then coin flip gambling. Um, what's the expected outcome? Okay, we expected outcome. Well, tail, I get nothing. Head, let's say I get what? 100. Okay, 100. Half and half chance. Fair coin, right? So the fair coin, the expected outcome is 50. Okay? The interesting thing is, okay? If I get $50, for sure, I would be this much happy. But because this is a coin flip, which is risk taking, 뭐 아니면 또, okay, 뭐 아니면 또. It's like a great outcome or bad outcome with coin flipping. This is risk taking. I hate risk. I'm averse to risk. It's painful for me to go into that gambling place in the first place. Who goes there? Nah. No, right? So much so that the gambling of this coin flip, this utility, is only this much, right? This much. And then, as if, this is the amount called the certainty equivalent. Okay, certainty equivalent. The certain or risk-free amount that I want to get to be equally happy as this gambling of coin flip, right? Certain or for sure risk-free amount that I want to get, okay, to make me as happy as taking this coin flipping exercise. That's called certainty equivalent. Okay, and as you see, the more risk averse a person is, the curvature would be bigger, which means a more hump shaped risk aversion. Like, for example, kind of things, right? More risk averse. The function will be like this. Okay, less risk averse, what happens? The curvature will be like this, getting flatter and flatter, getting closer to the straight line, so much so that we call a certain people as risk neutral, like this, if his utility function is like a straight line, linear function of wealth. I'm as happy as much as I have the dollar amount happiness. I am happy. That's it. Nothing more. No risk aversion. Can you do that like that? Can we live like that? Unimaginable for typical people like me and you, maybe, right? Because, we all try to avoid this kind of uncertainty by nature, right? Somehow. Okay, I am happy as my money amount. Exactly. Zero amount, zero happiness. $1 million, happiness, and then $2 million, $2 million happiness. Okay, 2 times happier than $1 million worth. Exactly 2 times. Oh, $1 billion. Well, 1,000 times happier. Exactly. Okay, that's risk neutral person. When do we have this kind of utility? Well, if you think about the shareholders of a company, right? Shareholders, okay? Their utility is more like risk neutral, okay? Maximizing shareholder wealth, where shareholders are happy, 2 times happy if the CEO makes this market cap 2 times, right? 10 times happier if they're in aggregate, as a group of shareholders, they will be 10 times happier as the CEO makes the market cap 10 times bigger than before, right? So that's basically what the group of shareholders may feel it. This kind of utility function will be useful in corporate finance literature or studies over there, okay? But for individual investors, individual shareholders, I mean, not the shareholders, individual investors' behavior, not as close. We are more like this, right? This is more theoretical construct, but it's going to be useful, risk neutral. Here, risk averse, right? Averse. And the third graph is more like what? Risk seeking. Risk seeking, in that case, it's like this. It all has to do with gambling situation. It has to do with the gambling situation. The expected utility itself, right? Expected utility, okay? In the risk-averse case, the expected utility of this gambling will be this over here, right? The utility in each state and the probability assigned, cross multiply and get the average of it. That's it. Okay, that's expected utility. You had certainty equivalent over here, which is the wealth that will be make you happy as taking the risk. Okay, a certain or certainty, which means a risk-free compensation. Risk-free compensation that makes you equally happy as taking this coin flipping risk. Okay, and then the gap is so huge between your expected gains versus your certainty equivalent. And this has to do with your risk aversion. Risk aversion, which has to do with your risk premium. If you remember intermediate corporate finance class, your company's discount rate, expected return or required rate of return has to start with risk-free rate, okay, plus risk premium. Remember this part? People use risk premium, bigger risk premium for riskier companies, smaller risk premium for less risky companies, and risk-free asset, no risk premium. Only risk-free as rates will be enough, right? So risk premium was a very important component in our discount rate. This is going to show up again in this option pricing framework, okay? Now this one has to do with risk premium, more risk averse, bigger risk premium. Less risk averse, smaller risk premium for the investors, right? What about risk neutral investors? What will happen to this risk premium over here? Goes to zero, disappears. Because there's no difference between your certainty equivalent and your expected wealth that you get in your gambling, right? That will be discussed in the slide that you get over there. So let's get back, okay? So let's see. Risk averse, we have three different investors, three different kinds. One is risk averse, second is risk neutral, and the third is risk seeking investors. For these three different investors, I just assigned utility function differently. So the first risk averse guys, I just imposed the square root of wealth function. High school math, right, tells me that this It represents nicely about the risk aversion. And then second person risk neutral investors, just a linear function of wealth, which is 3 times the wealth. Okay, that's going to be your utility number. Don't ask me why 3. Okay, could have been any constant number. Okay, risk-seeking investors, well, W squared. Okay, quadratic function has nice convexity that represents this risk-seeking nature of these guys, right? Well, for risk-seeking guys, right? What does this tell me? Well, here is a risky decision making, 50-50 coin flipping, and head I gain 100, tail I gain 0. In the expected utility wise, right, it will look like this, but I come back over here later. Risk seeking guys, right? Risk seeking guys. Head I win, tail I get nothing. Okay, like this. And then the expected utility will be half and half point over here. You see that? And that utility of taking risk, okay, taking risk is what? Much bigger than risk-free gain of the same amount of wealth, expected wealth. Okay, 50-50. If I get $50 for risk-free, my utility will be only like this. But if I get $50 of expected wealth, $50, right? By going to the gambling place, I am happier. The sheer excitement of who knows what happens. And then 질라, like a 어이 젊은이 업고 더블로 가 kind of excitement, right? You like it. Then this kind of risk seekers, gamblers, utility function will like this, right? 업고 더블로 가. It's kind of a mindset. Anyway, 못 먹어도 고다. It's like a kind of in Korean gambling terminology, right? Anyway, expected utility, it looks like this. So expectation of your utility should be probability weighted average of your utilities in each state of nature. Okay, up and down like that. So our expected utility will be half and half times the utility of having $100 at the end and the utility of having nothing at the end. For the 3 different investors, let's see. First, risk averse investors, whose utility function is square root of the wealth at the end. And here is a gambling of 50-50 coin flip. Head I gain $100 and tail I gain 0. Okay, for the sake of simplicity of calculation. So the expected utility itself, right, is 5 if you do the math. Half a chance and then square root of 100, which is 10, right? And then multiply it, then it's gonna be 5. And then the other case is 0, which is 0 all the way down. So expected utility is 5. Then, so this is the utility that I can expect to have in the gambling situation. If I take the gambling, my utility will be 5. How about my utility at the expected gain of 50? The beauty of this expected utility theory is that those expected utility may be different from the utility of expected wealth or expected gain. Okay, so expected utility is 5, but what about the utility at the expected gain in the gambling, which is 50, and then take it to the square root, and then you'll see it's going to be 5 times square root of 2, which is 7.07, and that is bigger than 5, and you can clearly see numerically that it is bigger than your expected utility of taking the gambling. So you hate gambling over here, right? That is consistent with the idea of risk aversion. You hate to take risk. You want something for sure. If it is given, if the same amount is given risk-free, then you will be happier. Okay? You don't like gambling, right? He would be happier if 50 was given with certainty instead of risk-taking. Um, Expected utility is 5, and then what about the wealth level? The risk-freely given wealth level that gives him the same amount of utility 5. Well, the wealth has to be 25. The person will be indifferent between coin flipping and getting $25 for sure, risk-free. This is called certainty equivalent. So that's this situation over here, 25 versus 50. There is a huge gap between these two, certainty equivalent versus the expected gain, expected wealth at the end of the gambling. Okay, certainty equivalent, and this, the difference is related to your risk premium, okay, or risk aversion. And so the difference between the expected wealth of coin flipping and the certainty equivalent is related to the risk aversion of the investor. More risk averse, more gap, okay, more hump shaped it would be, right? More concave function it will be, more risk averse person. And then remember in CAPM and SML, security market line, yes. The risk premium is directly related to the risk aversion. The risk premium shows the concept of risk premium and risk aversion, and this, right, amount over here, right, that's what we are talking about. Taking you back to, remember in your intermediate corporate finance class, required rate of return is risk-free rate plus risk premium. And we had such a hard time, analyzing all these risk premium using cap and beta. But we are talking about this risk premium part over here. Why do we have this? Because we are risk averse. If you are not risk averse, for example, risk neutral, this will be gone. Okay? Risk seeking, this will be minus. Okay? But we are not going to talk about that much. But what we care about is risk neutrality, where we will not have risk premium at all. Okay, so wait for that. Now, risk neutral case. Okay, there we go. Okay, the utility function that I just give you as an example is 3 times wealth amount. Risky decision making, 50-50 coin flip, and expected utility should be 150 because half times 300 plus half times 0. How about his or utility at the expected gain of 50? That's exactly 150. The same as expected utility. Utility at expected wealth level equals expected utility of the gambling, right? That's what we call risk neutrality. And he would be indifferent between receiving $50 for sure and taking the risk of coin flipping. And then 150, and then should be 3 times W, and then the W should be 50. This is the certainty equivalent instead of taking gambling, right? Certainty equivalent, which is the same as expected wealth at the end of the gambling, right? So there's no difference, which means the risk premium will be 0 for this kind of investors. This guy is as happy as the expected wealth without any risk premium. Okay, risk-seeking investors are the third case, and I just impose quadratic function wealth squared. So risky decision making, yeah, the same thing. Expected utility will be 100 squared times half, which is 5,000. Okay. How about his utility at the expected gain of 50, expected wealth of 50? Okay, so 50 squared, 2,500, which is way smaller than 5,000. Okay, which is expected utility. So he would be sad if 50 was given for sure instead of letting him do the gambling. All right, very strange case, but this kind of guys exist, right? And sometimes we are risk seeking. In behavioral finance class, you learn about this, right? In certain situation, you become more risk-seeking than risk-averse. But anyway, the certainty equivalent is bigger than your expected wealth, right? What can you tell about his risk premium? Negative, right? But we are not going to bother about risk-seeking guys in this textbook today, in this semester, right? But we are going to work on with the risk-neutral guys, right? And then we are going to assume sometimes that the world is risk-neutral. So what happens and to the discount rate, okay? And this will simplify. Actually, if the world is risk neutral, then the discounting job, okay, will be a lot easier because you don't have to worry about risk premium, and then you can discount all the risky assets with risk-free rate only, one single rate that takes care of the rest of the discounting job. Simple world, risk neutral. All investors are indifferent to risk. Investors require no compensation for risk. The expected return on all securities is the risk-free interest rate. Okay, very strange things happen if everybody is risk neutral. This concept will be a hard one to digest at first glance, right? It takes time, but bear with me, please. So binomial option pricing is the first one to tackle, right? So typically it works like this. So here's period today, and the end of the period, so maturity, right? I would say day 0 and day 1, okay? And then you have a stock price of today, and then the end of the maturity. You have two simple states of nature. Okay, forget about the rest. The world will be summarized into two, nothing else. Boom or bust. So S1 up, S1 down will be there. Stock price up and down. Okay, and then the strike price. Okay, strike price will be somewhere. Exercise price in between. Okay, usually in between. Yeah. And then what do you have? Based on it, you can figure out the call option price in upstate and call option price in downstate, right? Call option value, okay? And then your job is to figure out call option value today, right? Then what do you do? Well, the idea is first create a portfolio, okay? First create a portfolio with call option and stock, okay? So much so that this portfolio will be having identical price at either upstate or downstate. They will have the same price, okay? Why is the same price? Well, if the portfolio has the same price regardless of the states of nature, it's risk-free. So once you get the value in the maturity stage, what you can do is discount this portfolio at risk-free rate, and so that you'll be able to get the today's portfolio value, and then once you get the today's portfolio value, the only unknown will be the call option value of today. Okay? So risk-free rate is used as a discount rate. Portfolio using your stock, okay, and then call option. But how many shares of your stock you will have in your portfolio? This guy called delta. We don't know, okay, how many shares of stock you were going to have in your portfolio, but let's put it delta. We're going to solve for it later on in the process. And then call option value, we don't know about it, but at the end of the maturity, you will have this call option value. Okay, the diagrams of like profit and loss tells you that there is the call option value in upstate or downstate. Okay, and then portfolio 1 in upstate will be delta. You have it? Yeah, all right. Delta S1 up and then minus call up. And portfolio 1 in downstate will be delta S1 down and then call option in downstate. So this is basically what you're going to get. And then the thing is, we want to make this portfolio risk-free so that we will be able to discount it at the risk-free rate, as I told you before. Upstate or downstate, good luck with stock, right? But the portfolio value has to be the same, okay? Let's create it that way. How do we create that one? Well, stock price and call option values are given already. The only unknown to satisfy that condition of identity will be delta. Okay, so you can solve for delta. That makes these two portfolio value identical. So that gives me the delta to be like what? Okay, this guy will be equal to that guy. Okay, so what would you have? Well, S1 up minus S1 down, and call 1 up minus call 1 down will be your delta. Make sense? Okay? Like this. Right. Like that. Okay? So delta will be like this. And we call it the hedge ratio. Hedge ratio. Why is it hedge ratio? Because we are perfectly hedged between upstate and downstate. And this is the ratio that satisfies this condition of making a perfectly hedged portfolio. Okay? And this is a delta. And then another thing we want to notice is that this delta is like derivative. First derivative of call option value with respect to stock value. You see what I'm saying over here? Here, the numerator is call option values change, and denominator is a stock price change at the end of year 1. Make sense? So it's like just like a first derivative, which will be useful in your future later on in your derivatives class. But anyway, this delta has the same idea over there. You're perfectly hedged between these two states of nature. Once you figure out this delta, your job is then to figure out the portfolio value, okay, and compute P1. P1 regardless of the state of nature, because it's going to be the same regardless of being up or down. Okay, and regardless of being up or down, the portfolio value is the same, which means risk-free, so that your portfolio value will be nothing but portfolio value in 1 discounted at risk-free rate. Make sense? So that's going to be your portfolio 0 value. And then what do you have? You now have delta. You now have stock price. The only unknown that you don't have will be this guy. Okay? Call option value, which you wanted to figure out in any case before. Right? So that's the call option value you want to get. All right? So the slide, okay, slide describes by word how we do it, okay. Right, maybe I would have to do it like this. So portfolio of stock and option, okay, will be your portfolio in this case. Then so the portfolio will be nothing but your stock you long for it or buy it, take a long position of it, long position, so that at the end of the maturity, you're going to have this stock S1 with delta shares, right? Times delta shares. And then you're taking a short position in a call option, okay? So why is that a short position? Because if you think about upstate and downstate, the call value will be bigger in the upstate and lower in the downstate. But you want it to be identical. So that to be identical, the thing that is bigger in the upstate, like call option definitely, has to be shorted so that you will be compensated later in the downstate, right? So take a short position in call and then long position in stock with delta shares. Now you want to figure out call value over here, right? And then you know S0, right? The problem will give you S0, of course, and then every day you can observe the stock price S0. And then, but you don't know delta, how many shares would I have to hold as a long position? We don't know. That delta we will figure out later. Once you figure out once you figure out the delta, right? You are going to use this relation, the expected value of the portfolio in time point 1, discounted at risk-free rate will be your portfolio value. And then you can solve for call option value. But to be able to use this equation relation, the values of the portfolio at two different states of nature has to be identical, the same, right? So P up or down has to be the same, and then we have this relation, and you solve for this delta as I showed you before. And as long as you know all these things, you can solve for delta. Then expected value of portfolio will be obtained, and then portfolio value of today will be obtained. Then finally, you get to portfolio the call option value. Okay, so that's one way of obtaining the option, okay, option price, right? Right. So here is an example with the stock, right? Largely, this discussion is coming from the John Hull's book of option pricing, and then here is the stock. An option matures in 3 months, and this is a European call option whose strike price is K. People call it strike price or striking price or exercise price. They all mean the same thing. Strike price K, $21. The stock price today is $20, right? And stock price in day 1 or maturity will have either 22 or 18. No other states of nature available, but these two are it. Okay, very simplified world. Unrealistic, but this is nice modeling to start with. Okay, so taking this, right, thinking about this option exercise price or strike price 21, you can figure out the call price or call option value in upstate, which should be 22 minus the strike price 21. And this one in the call option value in downstate, well, would you exercise this call option or not? You're not going to. It's suboptimal to exercise it. So it's rational to keep it unexercised. So that's why the call option value will be 0 over here. Okay? Because the stock price itself is very lower than the exercise price. So set up a portfolio of the stock and the option in such a way that there is no uncertainty about the value of the portfolio at maturity, and that means the same value in two different states of nature. That means perfectly hedged. And then so this means the portfolio will be risk-free, so the expected return should be risk-free rate for this portfolio. Okay? And then no arbitrage assumption is used over here. The only assumption over here, there are only two states of nature in the world. Now, portfolio, you long delta shares of stock and short position in one call option. Okay, why one call option? Because you want to figure it out easily later on, right? If it is n different call options, you will have more troubles. N unknowns, we don't know. So let's keep it simple. One call option, shorted. Figure out delta that makes the portfolio risk-free. So at maturity, the portfolio value would be either 22 delta minus 1 in upstate over here, upstate over here, and then 18 delta at the downstate, right? Your portfolio value will be either this or that. And these two should be the same to be risk-free. Okay, we want to be perfectly hedged. Okay, why perfectly hedged? Because, you know, we want to use discount rate of risk-free rate as our discount rate, and then to get to the portfolio value of today. Okay, so if you set these guys together to be equal to each other, you figure out that you realize that the delta has to be 1/4, which is a quarter, right? And this is the hedge ratio in this setting. Okay, so you take a long position of a quarter shares in your stock and short position of one call option. That's going to be the portfolio perfectly hedged over the next period at two different states of nature. Okay, so the riskless portfolio should be long quarter share and short one call share over there. Okay, now next move down to the next slide. The ratio of underlying asset that makes the portfolio of long position in asset and short position in the call option risk-free, we call this ratio hedge ratio. And then so once you obtain the hedge ratio or delta, okay, the next thing you have to do is to figure out the portfolio value in time point 1 or the maturity, because your job is not finished yet, because your job is to figure out the call option price of today, day 0, right? For that part, you must first figure out the portfolio value in day 1 and then discount it at risk-free rate to reach the portfolio value of today, and then subsequently figure out the call value. Now, portfolio value of day 1, how do you figure out? Well, stick in your delta, a quarter times your stock price 22 minus 1 should be 4.1 in upstate, and downstate it will be the same, 4.1, but just to check it, 18 times a quarter, that's it. Now, portfolio value today should be $4.5 discounted at risk-free rate. Okay, risk-free rate. Notice it is 3 months, and then the annual risk-free rate is 12%. So the quarterly rate will be simply just 3%. Just divide it by 4. Okay, so 4.5 divided by 1 plus 3%. That's 4.3689. In continuous compounding, how does it work? Well, 3%. So 4.55 times natural log e to the power of minus 3%, which is minus 0.03, right? So that will give me 4.367. Okay, so if it were finance basic course, I would have said 4.3689, but in options pricing explanation and then the derivatives class, I would say 4.367, okay, to be precise, right? Based on this, we can solve for call option value today because we have the portfolio information, so that once you stick this guy into your portfolio value, and you will have the call option value, okay, 0.633. By the way, 4.3767 over here is an abbreviation. It's like actually 4.3666666 something, right? So that's why we have a little bit of rounding error, okay, but it does not matter, okay, very small degree. So call option price, okay, of today, you obtained it like this, binomial option pricing. Okay, what was the idea over there? Well, first figure out, first set up a portfolio. First to set up a portfolio, which is going to be having identical value in the maturity, right? The portfolio should be constructed using the stack and the call option, long short position of the stack and call option, right? This portfolio will have identical value in the future, which means the portfolio will be risk-free. We create a risk-free portfolio like that, and then figure out the delta, the position on your long position on your stack. Okay, figure out the delta, which turns out to be the call option changes divided by stack price changes, or stack price differences at the end of year one, right? Maturity. And then once you figure out the delta, you can figure out the call option, the portfolio's value in the maturity, and discount it back to today. And then the only unknown by then will be your call option value. So figure it out. So that's basically first encounter of call option pricing. Now let's move down. Okay. So more generally, right, taking it more generally, I'm going to use the mathematical notation more intensively instead of working with the real actual numbers. So S0 moving up to S0 times U, which means up, and then down to S0 times D, right? This will be up and down will be proportionate number, like 1.1 and 0.9 kind of things, right? So then the important thing is D will be smaller than 1, but U will be greater than 1, okay? And then portfolio of long delta stack and short one call. So at the end, you are going to get, positive stack and then minus call. Anyway, so initial setup cost of the portfolio will be S0 times delta minus call option price. And then at the end of maturity, the portfolio values will be S0 times U times delta minus call price in upstate. And then downstate, it will be S0 times down D times delta minus call price at downstate. Okay, and then you can figure out, your delta using this equation that equates these two portfolio values, and delta is nothing but this hedge ratio C up minus C down over S up minus S down, right? Delta is the ratio of the change in option price to the change in stack price as we move between the nodes. All right. Node means this and this. Anyway, notice that we never talked about the probabilities of going up or down yet. Okay, we still got the option value, right? And also our option is risk-free. Okay, I don't know, portfolio is risk-free, right? So today's portfolio value, which is this one, should be equal to the present value of maturity's portfolio value. Okay, and then present value of this portfolio value, right, at the end of year one or maturity. And the present value over here, e to the power of minus r times rt, right? That's nothing but the present value formula, right? As I showed you before in the mathematical refreshers, right? Something something over 1 plus r, right? Kind of things in continuous time, manner, right? Continuous compounding manner. Now, once you figure out this value, what do you have? So call value will be nothing but S0 times delta minus present value of this ugly term over there. The present value. This implies something more, one more step actually. One more step. You can create your call option. Okay, this means that you can create a call option on your own. On your own? Can I make a homemade call option? Yeah, which is going to be buying your stock of Delta shares, and then what is it? Borrowing risk-free. Okay, borrowing risk-free of up to a certain amount. What? This amount you borrow it at risk-free rate, right? So that's the borrowing's value over here. Borrowing, so that you have obligation to pay at the end of the maturity. Now, so your stock and borrowing. Borrowing typically means treasury bond, right? Kind of risk-free borrowing. Okay, as long as you can do some risk-free borrowing and then buying the stock, right? You can create your own call option. Peanut butter and jelly creates a sandwich. My professor, like Goldstein, Robert Goldstein in University of Minnesota, always explained it this way. It's like a peanut butter and jelly. You can create your sandwich. All right. So that's that. Now, call option value will be like this. This means that you can create a homemade portfolio of stock and bond replicating a call option. We call it replicating portfolio, which is mimicking the payoff of the call option. All right, okay. And buying a call option is like buying delta shares of stock with borrowed money as much as the present value of delta S1 up minus call price in upstate discounted at risk-free rate. Risk-free borrowing and your stock. Simple to asset, you can replicate the call option, whatever asset that you want to, and then in upstate, you will have just to make sure this really works the same, right? Just to verify that this claim of peanut butter and jelly really makes sense. Let's put it, okay? And let me take you to day 1 and see what happens, okay? So in upstate, you will have delta S1 up minus the borrowing that you have to repay, okay? So S1 up minus call up, right? So this guy cancels each other out, minus plus, and then minus minus is plus, so that you will have call option only. Okay, so upstate call option is replicated. And how about downstate? Well, in downstate, you would have delta times S1 down. Oops, you have delta times, S1 up, not down. And then you have minus call up. Okay, you're in trouble. Not really. Why not in trouble? Because you have this delta, which involves up and down in the denominator. So let's see until you really see if it is a problem or not. Minus minus, it will be plus call up over here. And then the delta S down and delta S up, that will be minus like this. And then now you gather together like terms, right? This delta, gather together like terms. And then you have this up minus down. And then call, and then minus sign. Don't forget. And then the thing is, you stick in the delta. The thing is, these guys are the same as these guys, up and down, up minus down, right? And in the delta, what is going to remain is this guy, up minus down. Can you see that? Up minus down will remain, okay, in your delta, so that the up will be canceling with this guy. And then minus will be plus. So call down will be the only survivor. So what do you see? Your replicating portfolio of your delta shares and then minus risk-free borrowing, right? That cash flow is identical to the call options cash flow. At this point, people get awfully confused. What the heck? You created a portfolio before and you are creating another portfolio right now. Are these portfolios the same? So confusing. No, they are not the same. Okay? Don't get confused, right? This took a long time for me to realize. Oh, God, yeah. They are different, okay? The portfolio that we created at the first encounter was just a portfolio of your shares and then the call, okay? Long share and then the short call. The portfolio that we talk about over here is long shares but borrowing, risk-free borrowing, okay? The portfolio before, the first portfolio that you created is to create a risk-free portfolio, okay, whose cash flow may be whatever it may be in state 1, okay? We did not say the portfolio value has to be the same as call option. No, what the heck, it doesn't matter. The only thing matters over there is the portfolio value has to be identical upstate or downstate, so much so that we could discount it at the risk-free rate so that you can get the call option value at time point 0. Okay? Now the portfolio over here, okay, portfolio over here is once you figure out the delta, right? In the first portfolio, okay, the binomial framework, once you figure out the delta, this is just to tell you that you can create and mimic the cash flow of the call option by creating your homemade portfolio, which will be your stock and the risk-free borrowing. Okay, stock and bond, simple to asset, can create call option kind of cash flows. Okay, so two portfolios, different, but they are linked through this delta. Okay, linked through this delta. Now, let's go. Okay, so that was about binomial option pricing.